Good afternoon and welcome to this weekend's weekly market update from Time Price Analysis. This is being recorded on the afternoon of Saturday, the 23rd of March. Okay, so this is our long-term monthly chart of the S&P 500 index. And I want to go through this piece by piece because within it, it provides all of the details of the methodology that we use to analyze the markets. So let's start off with the roadmap. Where are we? And if I go all the way back to here, which is the 2000 peak, and I have that labeled as a cycle degree wave 3, Elliott wave wise. So very, very significant top. And from a Hurst perspective, it was a 9-year cycle trough, okay? Trough peak rather. What we then saw was an A, B, C correction. And the low in March 2009 is therefore a cycle degree wave 4. Now, what I'm going to do, I've had various emails over the course of the last week asking different questions, and one of those questions was, can you point us at a similar wave 4 to the one we're in at the moment? And the simple answer to that is not without going back many, many, many more years than this chart goes back at the moment. The data on this chart goes back to 1952, which is when we had the inception of the S&P 500 index. But obviously stock markets themselves go back way beyond that. What I can tell you is that this wave 4, which took in total from 2000 to 2009, so it took 9 years for that to unfold, was at 1 degree higher than the one that we are experiencing at the moment. If we go to the May 2015 peak into the February 2016 low, so that took just under a year. And that was a wave 4 at intermediate degree. And that is 1 degree less in terms of Elliott wave trend or fractal than the one we're experiencing at the moment. So one would expect this one to take longer than this, but less time than this, just being very simplistic about the analysis. Okay, let's then take the market from that 2009 low. And if that's a wave 4 at cycle degree, the move up out of it once it's complete will be the wave 5 at cycle degree. And there's a degree of debate once we get to the next major high, which will be at least 34,000 just over in the S&P 500, possibly higher. What that represents at the next fractal up, I think it's a super cycle degree wave 3, and therefore we're going to get a super cycle degree wave 4 that can come as low as the March 2009 low again. I would certainly expect it to come back to the 1800 to 1850 level in the S&P 500. And if you think about previous major, very, very painful corrections, they've tended to halve the market. So this here, what did we go from 1500 to 700, broadly a 50% correction. So that 1850 may well be what we see, which, from 3400 plus is going to feel catastrophic. If we come all the way back to 600-700 in the S&P 500 from that high, you can imagine the devastation that's going to cause to the world's financial systems and banking systems and all the rest of it. So when you read all the doom and gloom and stuff on social media, that's what they are talking about, and they've been talking about it forever. So yes, it's coming eventually, but that's not something you can trade off. So coming back to this chart, and I am going to labour this a little bit because I think it's important to understand how we piece these things together and where we derive our methodologies from. So the next thing, just sticking with Elliott wave, this wave 5 at cycle degree, Elliott wave is a form of repeating fractals. So we would expect it to subdivide into 5 waves at 1 degree less, which would therefore be at primary degree. If you look in the education section at TPA, it will give you under Elliott wave the nomenclature we use, the labels, if you will, and they are the standard ones as detailed in the Frost and Precher book on Elliott wave theory, with the exception that or the addition rather, that I color code them. So you will see that I have got the big circled numbers for primary degree, but I put them in green. And the reason I do that is to then allow us to take these Fibonacci projections over here, and I color code those. So what that means is when I say I'm looking for the 1618 Fibonacci extension for the wave 3, for instance, it means at, if I'm talking about the green fibs, I'm talking about the green labels. And the intermediate degree, which is the large bracketed numbers, I put in dark blue. So if you see dark blue Fibonacci projections on my charts, then they are relevant to the intermediate degree Elliott wave fractal. Light blue is for the minor degree, which is 1 degree down, and you'll see that from the daily charts and lower, etc., etc., etc. So that's just really to make everything nice and visual for you, so you can see what's going on. So where are we within this roadmap within the wave 5? Well, we had the initial 5 wave move up here. So each one of the waves 1, 3, and 5 within this 5 wave move will also, in and of themselves, subdivide into 5 waves at 1 degree down. So there's the wave 1, and within there you'll find there are 5 waves at intermediate degree to make up that wave 1 at primary degree. We then had a shallow wave 2 here. From there we had a 1, 2, 3. So let's look at this wave 3 here, which is the wave 3 intermediate degree of trend, or fractal rather, and that was the May 2015 peak that we saw in the US markets, followed by this correction that took just under a year into the February 2016 low, which was the wave 4 at intermediate degree of trend. And then we had another 1, 2, 3, 4, 5 into the October peak that we saw last year, that completed a full 5 wave structure from the bottom of the wave 2. So 1, 2, 3, 4, 5, making this the primary degree wave 3 that completed at that high. So the subsequent move down that we've seen into the December 26th low last year here is part of the primary degree wave 4. And if you go back to the video that I put out earlier this week, it shows you why I do not believe that that wave 4 is yet complete, and that the move up from it has all been part of a correction. So it's corrective up, and we have another leg down still to come. Okay, now just to add another couple of interesting pieces of information to what I put out in the video earlier this week about this rally that we've seen. This rally off the December low is very, very largely driven by corporate buybacks. we have had a very, very weak inflow of investor funds into the market so far this year. A total of 18 billion in investor and retail funds going into the market via ETFs year to date. Okay, compare that to 286 billion year to date from corporate buybacks. And we are about to go into a 4 to 6 week blackout period now, where we are not going to see those buybacks prior to the major earnings releases. And therefore, typically, we find that the stock buybacks or buyback programs simply stop, or there are blackout periods due to regulations during that time as well. Hence, the timing aspect is that adds weight to the idea that we have either seen this week the top, or we can still push slightly higher, but we are there or thereabouts. It also adds weight to the argument that this entire rally up off the December low is corrective. Okay, coming back then to this chart. And you've seen me use all these different Fibonacci projection levels and all the rest of it. Where do they come from? Well, again, if you go to the education section of the website and read up on the Elliott wave and also the Fibonacci sections, there's some recommended reading. And there are 2 books in there that I recommend you read by a lady called Constance Brown, who is quite a remarkable analyst, but she also is a particularly good author, I think. She lays things out very, very clearly. And if you look at what she suggests with Fibonacci work, if you look at this orange shaded box here on my chart, that encompasses the length of the first move up that we saw off that March 2009 low. And once we started to pull back, you draw the box around from the top to the bottom. The first thing you're looking for is for the wave 2, if it is a wave 2. At this point, we had no way of knowing that. Okay, we hadn't taken out this high, so therefore this could be corrected up against here. The reason we were able to ascertain that the low may well have been in, one of them was because we got a 5-wave move. 5-wave moves are never stand alone. They are either at the end of a move or the beginning of a move. So therefore, this was likely the beginning of the next leg up because it completed a full 5 waves. So the first thing you're doing is looking for a Fibonacci retrace fib within here. Okay, now without bothering to do that, we hit one of those and we push back up. So the next thing you're looking for is for price to come and penetrate the top of the box. Well, we got that here. Okay, so the next thing you do is you take the box and you duplicate it and you put it on your chart with the bottom of the duplicated box at this low here. Okay, and what you're looking for then is the top or the range within this box. And if we are in a directional move as opposed to a corrective move, the first thing one would look for is for price to break out from the top of this box. And that's what we saw here. So that makes this level at 1862 a fairly important level. From a Fibonacci projection point of view, and that's these fibs you see on here, the 1.0 extension, as we refer to, is where the length of this move is equivalent to the move off the retrace, the 2, to here. So these Fibonacci projections on the right-hand side are derived from taking the length of the first move and then projecting up off the bottom of the pullback. So you take the length of the wave 1 in this case and project up off the wave 2. And that's effectively what these boxes also do. You can also see here within this blue shade, the blue shaded area is a timing window, but there is the orange, this exact same orange shaded box projected here. Okay, And you will see people say that when you get a full 5-wave move, then it should complete at, it should or achieve a level of at least the 2.0 extension, the 200 extension, where the whole move is therefore off the first corrective is twice as long as the initial move. Well, there's our 2.0 Fibonacci projection there. So that's the length of this wave 1 off the bottom of this wave 2. But if we take this box here and just put it so that the bottom's on the wave 2 here, and if we do the same again where we take the top of this box and add another one here, that's what I've done here. And that gives us a level of 3431.93 S&P 500. So that's what we would expect to see from this entire move up now, having achieved this. And once we broke out here, this is what we were looking for. Okay, once we broke out from the top of this box here, then this became a highly probable, and therefore still is a highly probable overall target level for the entire move up. So if you take everything else off this chart and just put those on, that gives you a roadmap. What we then have is the next part of this initial move, and you've heard me talk about the 123.6 extension. So that basically it means that the next leg is 23.6% Fibonacci wise longer than its predecessor. And that is an interim step. We look for the wave 3 of 3. So the 1, 2, 3, the wave 3 of this next step up to achieve at least that. That is what we would normally expect. What we then look for is the wave 4 to do two things. It firstly must not penetrate the level of the wave 1 of the same degree of fractal. So this wave 4 at intermediate degree must not enter the territory of the related wave 4 at the same degree. So we can see in this case it didn't do that. And we look for it to hold support. Well, support here, you've heard the old technical analysis adage that once resistance is broken up through, it becomes support, and we often see it retested. And again, another comment that I had in a chat room this week from somebody was, well, I tend to draw straight horizontal lines on my chart looking for support and resistance, and when you revisit broken resistance, that's when I buy. Okay, let's turn that into a more mathematical methodology. There's that 1.0 extension, top of this box. That's the area we look for support for the wave 4. And guess what? That is exactly what we then saw. Okay, what we then look for is the next leg up to achieve the 1618 extension. So we're looking for the top of this leg off here to complete the 3 to come to the 60, to be 61.8 times longer, hence the 100 plus the 618, than the related wave 1. And if it goes beyond that, we look for the next 2 Fibonacci numbers up in the sequence, which are the 176.4, so 76.4 times as long, and occasionally the 2.0 itself, where you get a very extended third wave. And again, third waves typically are the longest and strongest. That is their characteristic, certainly in stocks and therefore stock-related indices. They do not actually have to be the longest, and often with commodities and currencies, they are not. The fifth wave can be. But they must never be the shortest. Okay, so we came here to the 1618 at 27.17. We just poked our head above it and got this slight pullback. And then that push up, which was the rally that we saw after the brief correction in January 2018, we then got another push up. And we came to just shy of, guess what? The 176.4 Fibonacci projection, thus giving us our wave 3. And once we started to pull back this late last year, that gave us the confirmation that we wanted, that that top was then finally in. Okay, so that works out to be a 4.5-year cycle peak that we have seen in the US indices, and I'm now looking for the related 4.5-year cycle trough, and here is the timing window for it. Okay, what I've also done is drawn this support zone on the chart, which is this green box shaded area here, and that is from the 1.0 extension here, which is this top of this box, okay, up to the top of this level here, the 123.6 extension. So I would expect to see us revisit this support zone in the wave 4, which means the wave 4 could come down as low as 1862 and would typically come down to at least 2151. Okay, so that's the area that we're expecting to be revisited. Then there is also another Elliott wave guideline. It's not an absolute rule, it is a guideline, okay, that suggests, and guidelines are more commonly true than not, okay, but what it says is that the wave 4 should revisit the vicinity of the wave 4 of 1 lesser degree. So that means that this here is where I'm looking for in terms of both time and price for the wave 4 to complete, looking for it to come down here on this chart. After which, and this we are here, this is where we are right now in the S&P 500. I need to just, that's where we are right now there. After which we would then expect to see another 5-wave move unfold to complete the primary degree, or as 5 primary degree 5-wave, wave 5 in this index, and that will complete all of the cycle degree wave 5 up off the March 2019 low. And that's predicted in this timing window here. Now bear in mind, this is a monthly time frame, okay? This is not designed for trading positions, but this is designed for you to position yourself with your longer term investments. It's to give you confidence, reassurance, a method, a roadmap, all those good things. So the positioning for longer term investors right now is you should be in cash. If you don't like to play the short side, you should stay in cash, and on the next major decline into this area, you would look to buy back into the market, whether you do that through ETFs or selected stocks, or a combination thereof for this move up here, which I know I've put the wave 5 up here. We would expect that to come to the top of this box at a minimum at 34.31. If we exceed that level, then we will duplicate this box one more time, and we will then subdivide this box into Fibonacci levels 23.6, 38.2, 50, 61.8, so on and so forth, okay? And the way that will look is, to keep things simple, we will simply add those ratios to these Fibonacci projections on the right-hand side of this chart. And I'm just going to add one more in, etc., etc. And let's add the 300 in. Okay. So by doing that, okay, up to the 300 level, that will, in actual fact, if you draw that box and add it in, again, if we were to duplicate it, that is where it will come. And we would look at each of these levels for extensions in the wave 5 all the way up. So you may well have seen projections from people up to S&P 500, 4,000. That would be between these two extensions here, and that is certainly not out of the question. You will also have heard other people give you all sorts of weird and wonderful names and methods and things that they think they've come up with. They haven't. What they have done is taken Constance Brown's work, I would suggest, which is the original text that I've ever found on this, and formulated something that they then like to brand as, or whatever they've done. This is the simplest and best way of doing it and explaining it that I've ever found. If you read the book that I recommend on the website that she published some years ago, and I think there's a follow-up book on the Fibonacci levels. There's the Elliott Wave book as well, which refers back. So start with the Fibonacci book and read both of those, then read the Elliott Wave book that she has. And she gives you exercises to complete at the end of each chapter, by the end of which that will allow you to produce your own version of these charts. And you can do this on all time frames. And for those of you that have been in our live trading room during the day, you will see me doing this in real time on anything down to a 1 minute chart to produce these levels for day traders intraday, because Elliott Wave is a fractal methodology where each and every wave, it's like a set of Russian dolls. So if you look at my 15-minute chart for any given instrument, it is the same chart actually on the computer as the monthly. They aren't separate charts and separate analyses. Every single chart is the same one, but you're viewing it from a different time frame, which allows me to drill in to each of the subwaves, for instance. So you'll see on the daily chart the 1, 2, 3, 4, 5 labeled in there. On this chart, they're hidden from view, but they're there. Okay, so that gives you an overlay of how we look at the Fibonacci levels and where we get our projections and this long-term roadmap from, as well as the Elliott Wave structure. And there's nothing complex about Elliott or Fibonacci at all. When you lay it out like that and understand it. It's like anything else. If you don't understand it and haven't learnt it, it appears complex. Once you demystify it, it's actually, like most things, pretty simple. So let's move on then to the Hurst cycles analysis that's also shown on this chart. Okay, so in terms of the Hurst expectations here, we've had this 4.5-year cycle peak in, and we're coming down into what should be a 4.5-year cycle trough. And there's the this isn't much good for trading in terms of the timing expectation on this time scale. This is a monthly chart because that's the timing range for it. However, what we can ascertain from that is that we have not yet got to the beginning of that time window, which starts in July this year. Hence the another piece of the evidence that I don't think this wave 4 concluded at the December low that we saw last year. In terms of the FLDs, so if I just zoom this chart out slightly, and bear in mind this is a monthly time frame. So these FLDs here, which I explained again in the video that I put out, we crossed down through, so bright blue, 36.3 weeks. So the 40-week cycle is actually running slightly short. That confirmed that this peak was a peak of at least the 40-week cycle. We then penetrated the dark blue line, which confirmed that the 18-month cycle, which is running slightly short again at 16.4 months, that this peak and this peak were definitely in. This here is the FLD of the 4.5-year cycle. And you can see we just came down and it acted as support. I am expecting on this move that we will penetrate it, and therefore then I'm going to be looking for this and this as the next two Fibonacci levels of support at the 138.2 and the 123.6. And as I say, the top of the support zone that we drew using Constance Brown's work, and it also ties in with the price area of support and resistance is at 21.51 in the S&P 500. So that's what I'm expecting to see. The epicenter of the troughs, if you will, is here, and that's not until March, April next year. And the only way I can see that is if we get that WXYZ pattern. I would actually expect to see this come in. I'm looking at this here, which I think the most likely timing for this is the late this year through sort of August time potentially. And if you go back to the daily chart where I've got some of the shorter cycles, then you can see that the timing expectation is for late August, early September this year, I think it was. I'll look at that when we come to the daily chart in a moment. So that's what I'm expecting to see. Then if we come down here, and I've marked on this chart the 9-year cycle peaks. So this peak analysis is done totally and utterly independently of the troughs analysis. So it uses, Hurst never did analysis on peaks, he only did it on troughs, with the cycle troughs all being synchronized. With the benefit of modern software, we are able to run a similar analysis on the peaks, which is very useful because it allows us to oscillate from one to the other in terms of expectation. So if each of these are 9-year peaks, then, and that this is the previous one, okay, then it is probable that this peak is going to be of an 18-year, because every other 9-year peak is an 18-year peak. So I suspect that this, in actual fact, was the last 18-year peak. This is 9, 9, 18. And with the harmonic ratios between the various cycles that Hurst uses, the highest cycle length he uses is a 54 period. And the next one down is an 18 period. That can be months or years. Therefore, there are 3 18-year peaks within any 54-year period. And I suspect, therefore, that the next peak that we see at the top of this cycle degree, wave 5, is going to be a 54-year period or cycle peak, which means we haven't seen in our trading lifetimes, certainly I haven't, a peak of this magnitude that is coming. Okay, now I just want to add another couple of little bits of or snippets of information here. Firstly, let's go back to the corporate buybacks situation. This is companies buying back their own shares, and certainly this year, just looking at the fund inflows, we can see that the rally has been largely driven by that. What happens is in low interest rate environments, we are going to see more and more corporate buybacks of shares, because that is the most attractive return available to the shareholders and the corporations, the people running those companies, because interest rates and keeping money in the bank and all the rest of it just doesn't offer the return. It also has the double effect of the dividend that they receive rather than paying it out to other people, and on it goes. And we've been in this very, very, very unprecedentedly low interest rate environment for a prolonged period of time. And you can see with the central banks, they are doing their level best to continue that and keep the lid on things. Now, let's also look at one other piece of information here. So again, this is a long-term chart of the S&P 500 price to earnings ratios. And if we go back here, this was what is known as Black Friday. This was what was known as Black Monday. And if you look at the PE ratios there on the S&P 500, this, which was absolute madness, was the .com bubble. And this is where we are now and where we've been at the recent peak. So you can see we're at highly, highly elevated levels already. Now, personally, I think this is going to continue to rise. We're going to have another .com type blow off into that peak in all probability. But this is dangerous stuff. And you can see, well, you all know what happened at each of these events and therefore what is coming. But I think it is a few years off yet. Okay, I think we have one more major 5-wave fractal run, if you will, to new all-time highs that are quite considerably higher than where we are now, before we see a blow off in this, and then we're going to get that. Okay, so that gives you the some information on the methods that we use and the overall analysis and the framework for it that I'm using in the US indices. And this is what I use on all of the different instruments that we track. Then obviously for the shorter term trading and the trade entries and all the rest of it, you can also use things like the squeeze indicator. And where the US indices are concerned, we also look at the sector ETFs. Okay, so let's then come down the time frames on the S&P 500. So firstly, this is the weekly chart of the S&P 500. There is that wave 3 hitting the 1764 extension. There's the A, B, C, or WXY more correctly, for what I think is an A wave down into that December low. Then we've had this rise, which counts best as an ABC, into this week's peak. And the video I put out was literally the day before we got that nice big decline in the markets. So I think it's possible now that after Friday's decline in particular, we may well now have seen the top. We did break the first level of support on the smaller timeframes. We do need to see the S&P 500 or the indices respect a retrace level after this initial small legs down, and then take out the low of it and continue down to take out various other support levels along the way. And it's either, as I said in the video this week, it's either an A, B, and we get a C down, or we've got a WXY to here. This is another X, and we're getting a Z wave. The only difference, the targets will be exactly the same. The big difference being that we will have a more complex structure to the downside, and it will eat up more time than if we just get a straightforward C wave down to a new low. And the levels to watch, they start at 23.26, then the 23.6 retrace, which is the length of this 3 off the bottom of its related wave 2, is at 22.85, and then there is that 21.30. So I would expect the wave 4 to be contained, the C wave, within that region in all probability, but we can go down to one of these lower levels, and that would not in any way breach the pattern, invalidate any form of expectation whatsoever. If we have to breach 1848 again down here on a sustained basis, and anything coming back up would have to be a retest of it to consider that we've got a larger degree top in place, and I don't think that's the case at all. Okay, then daily chart of the S&P 500. This was the chart that I used in the detailed video this week. That I think Wednesday or Thursday I put that out. And you can see we've come up to just shy of the target. 2870 was the target. I think we came up to 2864 or whatever earlier this week, and we've had this fairly volatile week. You know, we moved down at one part of the week, then this massive intraday rally followed by a reversal and taking out the low of that rally as well. And you can see on a Hurst perspective, we've just come down to this VTL, valid trend line here. So we've just come down to the 20-day VTL, and I've got the FLDs and what have you before that. We need to breach this slot to confirm that this peak is in from a Hurst point of view. And I would think that the initial move is likely to come down and test this area before we get another move back up and then come down. The support area shown is on the basis that if this is wave one of the next leg up, then we're going to get a 2, then it's going to come into here. I think that is highly, highly unlikely. I would give that more credibility or more weighting in terms of probabilities if we hold this low here and get another 5-wave structure that takes out last year's high. If this is an impulse up, I think this would be the wave 3. What we're seeing now is a 4 back down to the level of the previous 4, and then we'd have to see a 5th wave up. If we were to see that, then I would these levels would change, but I would then expect that support zone to hold, and the major degree 4 is in over here, etc., etc. Now, despite everything I've just said in my analysis, price is king. So if we see another major high, I'm not ruling out Friday's move down being corrective, and we see one last run up to hit that fib up at 28.70 or even up at 28.80 area. Everything I said about the levels that it would need to go to, and we'd need to see a full 5-wave structure up off whatever low we now see without breaching the support for a wave 4. So in fact, we can run, if I just put if I were to give that the benefit of the doubt as the wave 1 and put this on here, so we came just shy of a 223.6, that would have to be for the 3, we'd need to hold 26.70 and make another high up to the 29.46, 29.50 area. If we saw that, then I would think that the next move, the bigger move down, would be corrective. So one step at a time. For those of you that followed, and you should have seen the alert go out by email this week, we did late in the afternoon on Thursday's session take a position short in the S&P 500. We did so by buying shares in SDS, which is the 2 times leveraged inverse ETF on that index. Stops on that now are just a fraction over the area we entered at, so we've got almost no risk at all already in that position, and that fits with our philosophy of, you know, low risk, high probability trading opportunities is what we look for, and to get that risk minimized and off the table at the earliest opportunity. So that's exactly what you've seen us do in the course of the last couple of sessions. What are we looking for from here? So first off, we need to get back below this area here, here, and here. So we need to take out 27.70, followed by 27.20, followed by 26.13. Those are the 3 key levels of support in the S&P 500. As you can see on a 4-hour timescale here, this is the chalk-in money flow. It was been diverged from back here. It's gone negative now on the daily time frame. I've been showing this for some time, and you can see the money flows just coming down and down and down, and I can't tell quite whether it's breached the 0 line or just got to it on the daily chart, but certainly on the shorter time frames it has. And we also have MACD curling firmly back over, and again the divergence from this area here all the way through this last part of the move up. Okay, let's just then come down to a 15-minute chart, and you can see that in terms of this last A, B, C move, we came just within a hair's breadth of hitting the 1.0 extension, which was the ideal target for this at 28.65. I think we missed it by about a point. Then on Friday, we got this gap down, and it just continued lower. 2787, 2765, next two levels to watch in the S&P 500. Now, from our day trading room, here's the 3-minute chart of the cash market. Because of the gap down, it is quite tricky to ascertain exactly where this wave one was. And I've kind of borrowed information from the ES Mini futures, but I think the one was here, this was the 2, and that this was the 3 here, which was at the 223.6. We got this A, B, C, right back up into the 123.6 extension light on Friday afternoon and came down again. Then these pink fibs, bear in mind this is a 3-minute chart, we got a 1, 2, 1, 2, 3, 4, 5 into the 1618 extension at the low on Friday afternoon, and we got a minuscule bounce off that. I'm looking, as the futures open on Sunday evening, I'm looking for a little push back up and then a drop to 27.95 to 27.90 in the S&P 500 cash market, and that would complete all of initial 1 down. Okay, so if we are in the WXYZ pattern, that would be a 1 of the A wave. If we're in a straightforward impulse, it will be wave 1 of 1. In any event, the next steps will be the same. So I'm expecting a touch lower on Monday, not a lot, then an intraday reversal, probably early on, and a move back up to at least 28.35, possibly as high as 28.46 to 28.52. So I would expect a deep reversal or retrace in the index before we then see the wave 3 down. And the shape that's going to take, we'll obviously get the initial 1, 2, and then we should see probably as soon as this coming week, if not certainly the week afterwards, a very, very strong move to the downside, which takes out all of the upper levels of support and leaves us in no doubt that it's a third wave and that we are on our way to much, much lower levels in the US markets. So that's what I'm looking for in the coming week. Should we take out this resistance zone, followed by a move through 28.53 and certainly then the top, then the top is not in and we still have higher to go. And we will start to look at the possible levels for that. But one step at a time at the moment. We've got enough evidence to suggest that this move down could well be the beginning of the correction that we've been waiting for. We're positioned for it. Day trading wise, I'll be looking for a low on Monday, followed by a move to the upside, and then to get on board. And I may leave something on in futures as a swing trade as well for the next leg down.